Good afternoon, everyone. I want to thank you for joining us today at AAF's Individual and Family Tax and Wealth Preservation webinar. The purpose of today's session is to give you information you need to know in order to optimize your tax positions, both for 2023, but future years as well. My name is Rich Weiner, and I'll be moderating today's session. I am a tax partner in the firm with a specialty in mergers and acquisitions and other entity and individual wealth building and company building strategies. So without further delay, I invite our speakers to introduce themselves.
Hi, my name is Dan Seaman. I'm a tax partner. I work primarily with our wealth management department and working on helping them through their tax situations. I also am a leader in our high net worth group, and I work with closely held families. Welcome.
Good afternoon. My name is Jonathan Bloom. I'm a director and senior wealth advisor with AAF Wealth Management. My group works with individuals to create financial plans, manage their assets, and integrate their personal tax plans and estate plans.
Good afternoon. My name is Josh England. I'm a tax partner with AAFCPAs. I'm a tax attorney, been with AAF for approximately 10 years. I head up our trusts and estates department. I work closely with our wealth advisor group as well as our high net worth group.
Hi all, my name is Tyler Champagne and I'm a tax manager here at the firm and a leader in our entrepreneurial tax and advisory department focusing on private, closely held businesses and their owners.
Great, thank you everybody. And to kick things off, I'm going to turn things over to Dan Seaman.
Thanks, Rich. So I'm going to be talking about some individual changes that have happened in 2023, along with kind of what stayed the same. So let's start with what stayed the same. So the state tax limit on Schedule A for deductions on state taxes. So as everybody knows, no matter how many state taxes you pay, both real estate taxes and on the individual return, the cap is still at $10,000, which is still, a point that's especially warranted up here in the Northeast with the property taxes that we pay. Also still in place is the mortgage interest limit. So it's still limited to $750,000 for all mortgages after December 15, 2017. So again, all those older mortgages were grandfathered in. However, you're now still capped at the $750,000 going forward. And then the other thing that's still the same is you still get no benefit from miscellaneous itemized deductions. So, another big thing that happened after 2017 was the standard deduction increased significantly. So these are the rates for 2023. So I'm going to focus in on just a few. So for single, it's $13,850. Married filing joint is $27,700. And then qualifying widow or widower is $27,700 as well. And then head of household is $20,800. So what does this mean with the standard deductions being so high? It means that, it's more hard than ever to take charitable contributions on your Schedule A. So essentially what this has led to is a lot of people kind of looking at it and saying, okay, well, how can I still get that deduction on Schedule A? Well, there's a couple ways that we do that. One way is to stack donations. And so what I mean by stacking donations is essentially giving the charity all that money, say in year one, instead of spread over 3 or 4 years. And then that would enable them to itemize, allowing you to get a deduction. Another way to stack donations is also what's called using a donor advised fund, which I'm going to get to in a second. So how does this higher standard deduction affect the deductibility of charitable contributions? So let's assume in a case here that somebody's giving $13,000 a year to charity. So in this case, they gave $13,000 to charitable, as I mentioned. The mortgage interest was $5,700 and the taxes were $10,000. So in total, they're at $28,700. Standard deduction, this is assuming married filing joint, is $27,700. So they're $1,000 over. So they're getting essentially a $350 benefit at a 35% tax rate on that $1,000. Let's take that a step further and let's say that they do that over 3 years. So they do $13,000 a year. Over the 3 years, they're over $1,000 each year. So that yields a tax savings of approximately $1,050. So here is where stacking donations comes into play, and especially using a donor advised fund. So oftentimes people will say, well, I don't know if I want to give the charity all that money up front. So instead, what they can do is use a donor advised fund. they can put all that money in year one in there and then spread those payments out. They'll get a deduction in year one for it. And by way of doing that, they'll then be able to spread those payments out. So let's assume that they do that $13,000 a year, so $39,000, but they do it all in year one. They're $27,000 over the itemized deduction limit. So that actually yields a savings of almost $9,500. So with the donor advised fund, a couple of other things to think about. One of the key advantages to using a donor advised fund is you can fund it with appreciated stock. And we work a lot with our wealth management clients, especially on this, looking at it and saying, okay, well, if you use appreciated stock, not only do you get the benefit at the deduction at fair market value, but you're also pulling that gain out of your position, right? So you're kind of getting the best of both worlds. You can also fund it with cash, and you can fund it with other appreciated assets as well, such as like privately held stock outside of the regular stock that you're holding in your account. So a lot of benefits there, but as you can see, bunching those deductions and using that donor advised fund could be a significant tax savings. So another way to do this, and another technique that we do for charitable deductions, is do what's called a QCD, or a qualified charitable distribution. So you're allowed to do up to $100,000 directly from your IRA. You must be of RMD age, and you can use this to count towards your RMD. And by doing this also, you're directly removing that taxable income from your account. So a couple of rules around this though. The funds have to go directly to charity. So what that means is you can't take an RMD and then give the money to charity from that RMD that you took and get the charitable deduction. You'll still get a charitable deduction for it, but it could get held up on Schedule A. So the funds must go directly to the charity. Another key is the second bullet point here. You need to keep track of these donations. And the reason for that being that right now the IRS does not have a good mechanism to track when QCDs are done. So essentially you will still receive what's called the 1099-R at the end of the year, showing your total amount that you took out of your IRA. If your tax advisor doesn't know this, you need to then tell them that QCDs were done from that, because that is how you get those removed from income. So again, we work a lot with our wealth management clients to make sure in the coordination between Jonathan and I, who you'll hear from soon, we try to coordinate those to make sure that's tracked to avoid any issues there. And then another key here too is married couples can actually still do each of them can do 100,000. So again, it can be a huge benefit. Another technique that we use from a tax saving standpoint is what's called a backdoor Roth, right? So oftentimes when you want to do a Roth contribution directly, there are income limitations to that. So one way around that is what's called a backdoor Roth IRA. And this actually was looked at back in 2017, and Congress and the IRS said, no, it's fine. So what you do in this case is you set up a traditional IRA, you make a non-deductible contribution, and then basically after a few days, you just convert that amount into a Roth IRA. The last bullet point is the key here though. It only works well if you don't have other IRAs. And what I mean by that is that at the end of the day, when you go to convert it, it actually looks at it and it prorates, if you have other IRAs, the amount you're contributing. So essentially you can't pick and choose what you're converting. It just looks at all of your quote unquote IRA money as one bucket. So it really only works well if you don't have other IRA money. This is a reminder. So with the Tax Cuts and Jobs Act of 2017, a lot of those rules that came into place are set to sunset. So what does this mean, right? Tax brackets are going to go back up. The estate tax exemption will nearly be cut in half, and Josh is going to talk a little bit more about that and what that means later on. Miscellaneous itemized deductions will come back. The tax cap that's on there with itemized deductions will come back. And then the other piece too is the standard deduction will decrease and exemptions will come back. So this is just a reminder that at the end of 2025, things are going to change. Now, obviously, depending on election time, what happens there will kind of guide a lot of this, but just a reminder that if nothing happens, a lot of these things are going to come to an end in 2025. All right. So as many people saw, Massachusetts did have some tax reform that happened over the past month. What did this do? So there was an increased estate tax exemption. Josh is also going to talk about this later on. Another big thing was short-term gains. So previously in Mass, any short-term capital gains were actually taxed at 12%. This is now lowered to 8.5%. So a pretty significant tax savings there. There have been there were always tax credits for children / disabled adults. That actually increased from 180 to 310 in 2023. It's going to go up to actually $440 in 2024. So some small changes there. The rental deduction increased to $4,000. It was previously $3,000. And then the earned income credit went from 30 to 40% of the federal credit. So some changes there. Another key thing that started happening in Mass in 2023 is you can now deduct your charitable contributions. Here's a key though to it. It must be used on Part B income and cannot be used on Part A or Part C income. So what is Part A and Part C income? Essentially interest, dividends, and capital gains. You can't use it against. However, everything else you can. And as a reminder here too, Mass had previously, this was supposed to come into law a few years back. However, Mass has kind of continued to delay it. They finally haven't delayed it as of now. So everything is in play for 2023. Okay, now it is Halloween, so we can talk about some scary stuff that's happened. It's the Massachusetts Millionaires tax. So as everybody knows, last year at the end in November of 2022, Mass passed an amendment to the Constitution that essentially established an additional tax on income over $1 million. That came into effect on January 1st, 2023. So it's in play for this year. So a key here though is it's only in effect for when income exceeds $1 million. So let's take an example of somebody that has 1.5 million of income. The first million still taxed at 5%. That 500,000 overage, that is taxed at 9%. This million is going to be adjusted for inflation, so it will go up a little bit over time. So what can you do? So as part of the tax reform, one of the first things we thought of as tax preparers is, okay, file separate for Mass. Because at the end of the day, Mass had a flat tax rate. And a lot of times you could always file separate in Massachusetts, even if you did something different in federal, meaning joint. However, in the tax reform, Mass said, well, wait, we're going to take that away. So the only way you can actually do it going forward is if you file separate for federal purposes. As everybody knows, filing separate for federal purposes is generally not the most ideal tax situation. So that's in play for 2024. However, you can still file separate for 2023. So you could have 1 year. What are some other ways to do it? What are some other ways to spread income out? Because that's essentially the best way to try to get under that. You can look at installment sales, right? So if you have a case where you sold a business in that year, maybe you could do the installment sale method for Mass. Previously, you didn't really want to do that because at the end of the day, Mass makes you put up a bond to accomplish that. However, this is still an option. Looking at your state apportionment is always an option. You could look to relocate to another state. That's easier said than done, and there's a lot of places in there. And then the use of trust, which Josh will cover. And that leads us to poll question 2. So when thinking about your charitable giving strategy, have you ever explored the benefits of a donor-advised fund?
Great, thanks, Dan. And while the poll is up on your screen, just a couple of additional comments. Thinking about the backdoor Roth strategy that Dan covered, just to clarify one item, when it comes to IRAs, Dan's advice regarding the backdoor Roth strategy not working is very on point. However, for those of you whose only retirement funds are sitting in a 401k, 403b, or other similar tax-deferred plan, in those cases, the backdoor Roth strategy still applies. Dan also touched upon the idea of relocation, and it's certainly gotten a lot of attention in the last year and a half. All I will say is that relocation requires a lot of planning and a lot of lead time in order to be done correctly and to withstand a possible Department of Revenue strategy. So Dan, thanks again. And I will now be turning things over to John Bloom to discuss some other wealth preservation items.
Thank you, Rich. Happy Halloween. Good afternoon, everyone. I'm really happy to be able to follow Dan today as we work so closely with with a lot of clients and the strategies, a lot of the strategies that he talked to today, especially charitable giving, Roth IRAs, and some of the, and I'll also speak to some of the strategies that we use as well. So today, what I'm going to speak to is maximizing wealth with efficiency, and what that essentially means is, it's been a tough couple of years in the market. So it's important to make the most of the assets that you do have. So one way of doing that is by reviewing your year-end benefits. It's a great way to avoid paying taxes on part of your income. And I'm just going to touch upon a few quick benefits. The first of which is a health savings account, or an HSA. An HSA is one of the best retirement savings vehicles out there. It's the only plan out there that's actually triple tax-free. So it goes in pre-taxed, it grows tax-free, and it comes out tax-free, which is a huge advantage. Now, there are a couple of restrictions on who is eligible to have an HSA. So first of all, you have to be covered by a high deductible health insurance plan. If you're not sure if your plan is a high deductible plan, it makes sense to either reach out to your health insurance provider or possibly your HR at your company, and they would be able to let you know. You also have to be before the age of 65, for the pure reason that once you reach 65, you're eligible for Medicare, which is not a high deductible plan. So that is one restriction. But again, HSAs allow you to put in pre-tax, between $4,000 to $8,000 into an account, an additional $1,000 if you're over the age of 55. What's neat about these accounts is they can be invested, and as I mentioned earlier, they grow tax-free. What you do want to be, one consideration with these accounts is that they do carry over balances from year to year. So you want to think to yourself, when does it make sense to actually spend this money? One recommendation that we do make to our clients is saying, hey, put as much money into this as you can, allow it to grow tax-free until retirement, and then pay some medical costs out of pocket. That will allow the assets in this account to be invested, grow tax-free, and then use it when you most need it, which is generally in retirement. Another type of account that I'd like to talk to you about is a flex savings account, which is similar to a HSA, but you do not need to be in a high deductible plan. These plans are generally available through employers. You can put in about $3,000 towards qualified medical expenses. You can carry over a little bit, about $610 from year to year, but this is an account that you should really plan on spending all of it during the year. Anything beyond that $610, you will lose. Not all employer plans allow you to roll over money, so that would be another question you might want to run by your HR department. Another type of account that I'm very passionate about is the Dependent Care Flex Savings Account. Now, this is an account that allows you to put $5,000 into an account, again, pre-tax, that can be used for any sort of dependent care services like preschool, summer daycare, day camp, daycare, after school care, things like that. So unfortunately, this isn't one of the type of accounts that they increased the amount that you can put in there. As most parents know, daycare is extremely expensive and it goes pretty quick. You can't carry over balances, not that there would likely be anything left over. But again, make sure to spend it all, because with these accounts, if you don't use it, you do lose it. So that is some ways that you can save money through some employer options. But moving on to the real trends that we're seeing in the market, right? A continued trend from last year is what's been going on with interest rates and inflation. So as everyone's seen just by going to the grocery store, inflation has been a huge theme over the past couple of years. It's the job of the Federal Reserve to try and control inflation to their best of their ability. It's the main tool that they have to be able to control inflation is working interest rates. So they've increased interest rates at a historic pace over the past few years. Now, doing this it really has created some real challenges, but also has opened the door for some opportunities as well. In terms of the challenges, it's created a lot of volatility in the bond and equity markets. So every time we see rates go up, it's really putting downward pressure on the prices of bonds. It's also created some uncertainty and volatility in the equity market. So as I mentioned earlier, it's been a pretty tough environment for investors over the past couple of years. But the higher interest rates has opened the door for some new opportunities as well. So anytime you're buying a new bond now, you are getting a higher yield, whether it's a bond or a CD. You're really seeing higher rates than we've seen in 15, 20 years, which is great, especially for a lot of retirees that are looking for safer income. Speaking of higher rates, if we take a look at what's happening with cash and money markets, you can get some real interest, some real good interest in just for holding cash right now, up to 5%, maybe even a little bit more. We would encourage you, if you do have cash sitting in a bank account, look at what the rate you're getting is, and look for some other options to make sure that you're receiving at least 5%. If you do have any questions on that, reach out to us. We're happy to point you in the right direction and give you some advice there. Speaking of cash, it makes sense to hold on to that cash as long as possible, since you are now earning meaningful interest. One strategy that we've talked to some clients about is, when Dan and I talk to clients about year-end planning, especially when their next year's tax returns come out, a lot of clients are paying estimated payments, right? So, or quarterly estimated payments. Now, if you don't pay your estimated payments on time, when you file your tax returns in the following year, there could be a penalty for paying your taxes late. So a way to get around that is through withholdings, whether that's through an employer paycheck or required minimum distributions for those of you who are taking them. So a strategy that we've used is, especially around RMDs, or required minimum distributions, is holding off on taking them until late on the year, hold on to that cash throughout the entire year, and then withhold a large amount of taxes from those required minimum distributions to satisfy your tax payments. Again, when you withhold taxes from your required minimum distribution, the timing of it does not matter. So it's a way for you to hold on to your cash longer and earn interest instead of giving it to the government early and not receiving that interest. Another thing to consider is your thinking around paying down debt. So a lot of people over the past 5 years have gotten mortgages or other debt at very nice rates, whether it's a 4%, 3%, 2% mortgage. Those low rates are a valuable asset right now. So, for a long time, myself included, I'd say, hey, let's throw a little bit of extra money at a mortgage. But now, if you're earning more in cash than your loans are costing you, consider holding on to that cash in a cash account earning 5% instead of paying down a 3% mortgage. If at some point interest rates end up going down and you're earning less than it's costing you in your debt, then you can always put it towards that debt. But don't pay down a lender's bad debt 3% mortgage when you can earn 5% in cash. So as I mentioned earlier, we have had some turbulent markets, this year and last year especially. A couple of ideas to consider, some of which Dan mentioned earlier. One was going to be a Roth conversion. If you do have some qualified accounts or retirement accounts that are at lower values, consider Roth conversion and allow the rebound or the growth of your accounts to be tax-free. Another is for non-qualified accounts or brokerage accounts would be to tax loss harvesting. So if you have any positions that are showing at a loss, consider selling them, taking that loss and investing in something similar that can help. Those losses can help to offset some future gains. And then a third idea is consider increasing some of those contributions, both in the type of accounts that I mentioned earlier and then also some retirement accounts like 401ks or 403bs. We did recently put out a blog. We have the ability to actually help some of our clients with that and managing their participant 401k or 403b plans on accounts that are not held with us. And we have the ability to make sure that those asset allocations and contributions look correct for them. It makes sense to make sure that the entire asset allocation is looking correct too, whether it is a retirement plans or actively managed plans as well. In these turbulent markets, there can be portfolio drift where it could become too aggressive or too conservative. So again, revisit that, make sure that you have the asset allocation that you intended to have. And then also, please make sure you're revisiting your financial plan periodically. We do this with our clients almost every meeting to make sure that their financial plan is looking correct and still on path with the goals that you may have. If you do have any questions about anything we talked about today, please feel free to reach out to myself or anyone on our team. That brings us to our third poll question. So when you're chatting with your wealth advisor, how often does a topic of tax strategies and their impact on your financial plan come up?
Great. Thanks, John. Just a quick comment while the poll's up on your screen. John spoke quite a bit about HSAs and FSAs. For anybody viewing today's webinar that is approaching Medicare age, or perhaps has already turned 65 and is continuing to work, the interaction of HSAs, FSAs, and Medicare can be a little bit of a maze. And within John's group, we have plenty of know-how to help you navigate through and determine what is best for you and your family. Thanks again. I am now going to turn things over to Josh England to talk about how some of these strategies impact estate and trust planning.
Good afternoon, everybody. My name is Josh England. I'm going to be talking about changes to the Massachusetts and federal estate tax. The estate tax is a tax on your death, on the fair market value of your assets. For federal purposes, that estate tax can be as high as 40%. Whereas for Massachusetts purposes, it's a graduated rate somewhere between 4 and 16%. Massachusetts has made some significant changes for on the estate tax for this year. Previously, in 2022, the exemption was $1 million, meaning that if your estate was less than $1 million, you weren't subject to that Massachusetts estate tax. The governor just signed a new statute going in effect January 1st, 2024, to raise that Massachusetts estate tax exemption for 2023 retroactively to $2 million. And going forward, it's going to stay at $2 million. There's no inflation adjustment. Now, while we've doubled our exemption, all we've done is gone from the worst state estate tax to the third worst. We now beat Oregon and Rhode Island out of the 13 estates that do impose an estate tax. So it's important to note that in increasing that estate tax exemption to $2 million, they actually changed the way the estate tax was calculated. Under the old method, it was what we call a threshold method, meaning that if you had a $999,000 estate, you had a zero estate tax. Whereas if you went $1 over that $1 million threshold, you now had the requirement to file a Massachusetts estate tax, and you paid Massachusetts estate tax on the entire $1 million. So as an example, if you had a $1,100,000 estate, the estate tax was $38,800. You have a $2 million estate, the estate tax was $99,600. So by increasing that threshold, or by increasing that exemption to $2 million, Massachusetts has now given everybody that $99,000 gift. So for example, today, 2023, if your estate was 2.1 million, then the estate tax is only $7,200. And as I mentioned, the rates are now between 7.2%. That's the amount over $2 million, and 16%. So Massachusetts does not have what's called portability. Federally, we do enjoy portability, meaning that at the death of the first spouse, whatever exemption they have left over on the federal side passes to the surviving spouse with proper planning. meaning an election made on the final estate tax return for that first spouse to die. In Massachusetts, that's not the case. And so if you have what I would call I love you wills, where you just leave everything to your surviving spouse, then at the death of the first spouse, their $2 million exemption is lost and never used. And so therefore, at the death of the surviving spouse, any assets in excess of that $2 million are now subject to that Massachusetts estate tax. Whereas with proper planning, what we would call a marital family trust, or you may have seen it referred to as an AB trust. What we do is we put assets into each spouse's name while they're alive. They each have a revocable trust, and that trust provides that at their death, we're going to set aside the first $2 million in their estate and put it in a special trust that's available for the surviving spouse, but not includable in the surviving spouse's estate. And so therefore, we get the $2 million exemption used at the death of the first spouse, and at the death of the second spouse, all of their remaining assets, other than that first $2 million, are subject to the Massachusetts estate tax, effectively using $4 million of the exemption. Now, most of you probably already had these types of trusts in place if you were worried about the $1 million Massachusetts estate tax. Having gone up to $2 million, those same planning that you had done previously is still effective and still important. But I would encourage you to speak to your AAF advisor to take a look at those documents and make sure that they do what they're intended to do. So what's important to remember is while Massachusetts is an estate tax on Mass residents, they also go after non-Mass residents. But Massachusetts is only able to tax real property here in Massachusetts. But as an example, let's say your total estate is $10 million, and of that $10 million, 2.5 of that is Massachusetts real property, or representing 25% of your estate. As a Mass resident, you would pay an estate tax of $968,000 on that $10 million estate. As a non-resident, the estate tax would be $242,000, or 25% of that $968,000. Now, it's important to note, with proper planning, we can shield that Massachusetts real estate from the Massachusetts estate tax. But it's important that you speak to your attorney or AAF advisor to implement that planning to eliminate that $242,000 in estate tax that you would otherwise be paid. I often call the Massachusetts estate tax a tax on those who failed to plan. With good planning, that Massachusetts estate tax can often be reduced and or eliminated. So as I mentioned, there is also a federal estate tax. That federal estate tax for 2023 is $12.9 million. In 2024, that exemption goes up to 13.6. It is adjusted for inflation, and in 2025, it will go up further. However, on December 31st, 2025, that estate tax is going to drop in half, as Dan mentioned earlier. And that's part of that sunset provision that we saw in the TCJA under the Trump administration. A lot of the changes that they made, including doubling the federal estate tax, sunset as of December 31st, 2025. Now, we'll see what happens in the next election and whether that sunset will continue to exist afterwards. But for now, we have to plan accordingly. And so, when we're thinking about that, one of the key things is to make sure that we use up that $13 million exemption before it disappears. If your estate is worth $13 million today, and on December 31st, your exemption goes down to $7 million, you've now exposed half of your estate to that 40% federal estate tax. So what can we do to try and reduce or eliminate that concern? As I said, if you're worth 13.5 million today, considering a 5% compounded growth, your estate after 20 years could be as much as 34 million. So, the federal estate tax today on that 34 million would be 1.4 million, assuming a married couple. The Massachusetts estate tax would be 4.7 million. So again, you want to talk to us to talk about the different kinds of planning opportunities there are out there to try and reduce that estate tax exemption or estate tax on your estate that your heirs would be paying. And one of the ways to do that is to make completed gifts today of the 13.5 million to eliminate all that future growth, the $20 million of future growth that you see here in that example. Now, most people don't want to make completed gifts because that means giving up control over the asset and not having access to that asset. So what can you do? One of our favorite techniques is what's called the Spousal Lifetime Access Trust, or a SLAT. You'll find that estate planning attorneys, we use a lot of acronyms. And so, the idea behind the SLAT is I make a completed gift to my spouse of all of my assets into a SLAT for their benefit. I can still control it, and I can have benefit over the trust that my spouse has created for me, and still have access and control over those assets, but having made a completed gift, taken those assets out of my estate for estate tax purposes and taken all of that future appreciation out of my estate. It's a very effective plan for a husband and wife. For a single individual, it's a little more difficult, but there are opportunities available to maximize use of that current $13.5 million exemption that you enjoy. Now, it's important to note that when we're talking about the federal estate tax, there's a concept called the step up in basis. And that step up in basis says that if I die owning an asset, my heirs get a step up in basis to the fair market value at my date of death. Meaning if I buy a share of Apple for $100 and that share of Apple goes up in value to $300 and I die owning it, my heirs step up in basis to $300. And if they sell it on the next day for $300, they would pay no capital gain on that sale. The $200 of built-in gain disappears. Whereas if I gift that asset during my lifetime, my heirs get a carryover basis and they would still be subject to that $200 of gain that we talked about with the Apple stock. And so with the SLAT, because I am making a lifetime gift, my heirs would get a carryover basis. So, you have to consider what's more important, getting that step up in basis or eliminating the estate tax. When we're talking about the federal estate tax, that's a 40% estate tax versus a 20% capital gain. But when we're talking about the Massachusetts estate tax, it may only be a 10 or 15% estate tax versus a 20% capital gain. So we need to weigh the consequences of each one and what makes most sense for everybody. There's also an income tax concept or strategy that we use called an upstream trust. And that is a trust to take advantage of the estate tax exemption of some of our elderly relatives that may not be using up their full exemption. If my mother lives in Florida, where there is no state estate tax and only has a net worth of $1 million, then that means she's got 12.5 million of federal estate tax exemption that's going to go unused. I could take some of my appreciated assets, put it into a trust for the benefit of my mother and myself and my children and my spouse, and give her just enough control over that trust such that at her death, the assets are includable in her estate for estate tax purposes, and therefore I receive a step up in basis in those assets at her date of death. Now, there's ways to ensure that in creating this trust that you can maintain control of the asset, and there's no risk that my mother, in my example, could divert those assets to some of my other siblings. So it's a really effective income tax strategy for increasing the basis and eliminating significant amounts of capital gain. Dan mentioned that as we're thinking about the mass millionaires tax, that tax on the additional 4% on any income in excess of $1 million. There may be ways to minimize that tax or eliminate that tax, and one of those is to force the income over more than one entity. And for that, we would use what's called the Delaware Incomplete Non-Grantor Trust. And essentially, the idea is that, whoops, too far. Got to back up. How do I back up? Well, we'll wait. The idea of that Delaware Incomplete Non-Grantor Trust would be, for example, if I have a piece of property worth 2.5 million and I'm selling it today, then if all of that gain shows up on my personal tax return, then 1.5 million of that is going to be subject to a 9% tax. But if I were to gift parts of that property into separate trusts that are their own tax-paying entities, then that gain on the sale of the property would be spread out over those separate trusts. So in my example, I could create 2 separate trusts and make a gift of 1/3 of the interest in that 2.5 million property to the 2 separate trusts, and therefore each trust would only report $830,000 worth of income, and I would report $830,000 worth of income on the sale of that $2.5 million property, therefore avoiding that additional 4% tax on the 1.5 million. The Ding Trust has a lot more other uses to it. It can be used to eliminate state income tax entirely on the sale of your Massachusetts business. It can be used to increase some of the federal exemptions available to you on the sale of your business. And so there's a lot of opportunities out there using these various types of trusts, not just for estate tax purposes, but also for income tax purposes. And we would encourage you to reach out to your AAF advisors to learn about those different techniques that might be available to you. Next screen. Thank you. So now we'll be going on to poll question number 4. And the question is, do you have property in multiple states?
Great, thank you, Josh. One of the things that Josh brought up was the idea of people who have perhaps moved out of state to Florida, but keep a vacation home somewhere in Massachusetts. And I just want to reiterate the importance of planning to avoid the Massachusetts estate tax. And along those lines, we have a question in the chat asking about what type of documentation is needed to support a relocation out of Mass. All I'll say is that the list is lengthy, and in order to prevail against the Massachusetts assertion that you really haven't moved out of Mass, it's based as much on what you do subsequent to filing those documents as much as filing the documents themselves. And we would be happy to discuss that question with you offline. And I will use this as an occasion to remind people that if you have any other questions, to please drop them in the Q&A box. To set up our last session, there are a number of people in this call who have an interest in family or other closely held businesses, and there are a number of business rules that affect individual tax planning. And to cover those items, I'm going to turn things over to Tyler Champagne.
Thanks, Rich. As Rich alluded to today, I'm going to run through a handful of tools and reminders that could help bolster your business's ability to deliver valuable results to its stakeholders. You might be thinking, hey, AAFCPAs, your business webinar is Thursday. You got the wrong day, buddy. Well, we're touching upon this topic today to just kind of reiterate and highlight what Rich said. A lot of individuals and estates are directly affected by what we call pass-through entities. And entrepreneurs, family-owned business owners, and the like all use the ever-popular partnership or S corporation structure, where business profits are reported on individual or a trust tax returns. So without further delay, get into it. So some business planning reminders. First off, we got the reduction of bonus depreciation from 100% to 80%. In prior years, we had the luxury of having one less consideration when contemplating between this method and Section 179, which some of you may be familiar with. With a 20% reduction in the accelerated benefit, it adds another cog in the fixed asset wheel. Unless any change is made to legislation, the bonus depreciation deduction does decrease in these 20% increments annually until the end of 2026. So starting in 2027, for those of you who are planners, the deduction will no longer be available. I said just a few moments ago that there's one less consideration that we used to have. Well, what are the others? Just to name a couple, we still want to be wary of the beneficial owners of pass-through entities and the applicability or effectiveness of bonus depreciation at the state level. Next up, we have the meals deduction reverting back to 50%. So cue the grumbling tummies. Simply put, the 100% deduction for food and beverages provided by restaurants is officially expired. It's also worth remembering that as part of the Tax Cuts and Jobs Act, TCJA, entertainment expenses are 100% not deductible. That's mostly bitter versus sweet. We know that, but maybe it's proven to be better for business development. With the higher cost of taking clients to Sox games, sales folks are more likely to close that deal. So a few additional planning reminders for us, self-employed health insurance. So the common ones that we see: medical, dental, vision. Long-term care is one that we often advise on that some clients didn't know was deductible. One additional one would be Medicare premiums that you see deducted from your Social Security distributions. Those actually do qualify as a self-employed insurance deduction. If you have any other supplemental health insurance plans, be sure to note them as well with your tax advisor, because we want to make sure that you're capturing all of your applicable deductions. And separately, on the topic of self-employed health insurance, depending on the facts and circumstances, it's possible that your entity structure could add on extra tax costs as well. So just be pretty wary of this. I know that this is a relatively smaller item compared to, say, the qualified business income deduction, but it's often overlooked, and it's a detail that could add some money back into your pocket. So talk about segues, qualified business income. Consider analyzing the components of QBI. So thinking back to what I said earlier about applicability of business and this webinar, this provision of the tax code, section 199 capital A, it strictly affects individuals, estates, and trusts. So what is it? Some of you may not know, some of you may. Simply put, deduction is a function of wages, your adjusted business income, and property that you own within the business. There are strategies available to business owners that allow for maximizing that deduction through thoughtful planning. Of course, as with a lot of good things, this is set to sunset on December 31st, 2025. Moving along, one thing that doesn't appear to be going away anytime soon, for those of you with S-Corps, you may already be familiar, but Form 7203, this was new in 2021. I don't want to talk about the form in its entirety, but one portion of it relates to shareholder loan accounts. So this form asks you if the funds that you lent to your company relate to an open account or a formal note. Think of an open account like a running tab, whereas a formal note involves something like a valid and enforceable obligation to make payments. So very, very serious. And so the latter there being what we call a bona fide loan. And in some cases, when you're getting repaid by your S corporation for that money that you loaned it, the note that you're getting paid back for, it may actually be taxable. So if you have a bona fide loan, in other words, it's a valid and enforceable obligation, you'll be taxed at preferential rates as opposed to your marginal ordinary rate. It could be substantial tax savings, especially if you're not expecting to be hit with a tax bill. Next up, IRC 174. Those of you who are involved in the R&D space may already be familiar with it, but it's something that went into effect January 1st, 2022. So of course we are about 2 years into this whole change, but basically it comes down to removing the option to expense research and experimental expenditures in the current year. Instead, you're required to capitalize and amortize those expenses over 5 years, and in some cases it can actually be longer. Earlier this year, there was a lot of talk that this could revert back to the old rules. In other words, immediate expensing of any R&E expenditures, but legislation hasn't changed yet or at all. Therefore, we do need to follow the rules as they stand. It's a complicated issue. We did see it with a lot of clients actually in 2022, and we continue to see it in 2023. A lot of companies, including those in the manufacturing and construction industries, are particularly hit. Next up, pass-through entity tax. This may be something that you're familiar with, may not be, but in the tax community, it has been a very popular source of entertainment, I suppose. But either way, so pass-through entity tax, we also call it PTE. It's generally available for partnerships and S corporations through 2025 at the state level. As Dan noted earlier, the state tax limit remains at $10,000 on Schedule A. And so what the pass-through entity tax does is it's intended to work in the favor of individuals who are at that limit, but receive pass-through income. And so think of it this way. If you're paying $10,000 or more in real estate taxes on your home, which isn't terribly unreasonable, you're getting no federal tax benefit for the state income taxes that you pay on the money that you earn. So you're kind of losing out on a bit of that. And so PTE, pass-through entity tax, is considered an ordinary business expense, and it's actually deducted from your business's income versus the alternative of being reported on Schedule A, where you may not receive any deduction at all. I have no doubt that an AAF advisor or your AAF advisor would be happy to discuss this one with you. And so moving along here, we have a couple of things that I want to touch upon with respect to, and I'm sorry, for some reason the PowerPoint disappeared. There we go. Talk about some retirement plans. So simple IRAs, sorry about that. Simple IRAs are less common, but they're worth noting as a budget conscious option because it's just simply easier to set up. Despite IRA being in the name, contributions don't count towards personal traditional or Roth IRA contribution limits. So even though they don't count towards that, they do count towards your annual elective deferral limit. And that elective deferral limit is often just what people call the 401k limit. So that number is $22,500 in 2023 and $30,000 for those are 30 and over. The simple IRA limits are actually either 100% of your compensation or $15,500, whichever is lower. So if you do make over $15,500, you won't be able to max out that annual elective deferral. And there is a catch-up available for those that are over 50 of $3,500. The bonus for this, Congress threw in a kicker for eligible employers to set up qualified plans. There's a credit available for up to $5,000 of startup expenses in the first 3 years of the plan. To be clear on that $5,000, it's the maximum that can be taken over those 3 years. It's not $5,000 annually. And it does actually qualify under other qualified plans such as SEPs or 401ks. So just in summary, simple IRAs, they're simple and easy to set up, but the contributions are relatively inflexible and they're not as robust as a 401k or other profit sharing vehicles. Moving to defined contribution plans, sorry. So this is a plan for employees. It doesn't promise any specific benefit at retirement. So, you're kind of subject to what the market decides your retirement is worth. Employers and employees are eligible to contribute. Sure that this kind of sounds familiar if you're following along here. It includes 401ks, 403bs, and others. But compared to the simple IRA, it's much more robust. And it actually is one of the types of plans that's covered by ERISA. And this just means that it requires transparency and accountability for fiduciaries so that there's no mismanagement or abuse of funds. So it's just a little bit of a higher standard from simple IRAs, but with that does come the higher cost of management. Finally, one kind of dying breed of planning, retirement planning is defined benefit plans. Generally speaking, these are less common nowadays because they represent an ongoing liability for the employer. But our wealth management team does help advise on these plans with respect to setup, cash balance plans in particular. So for closely held, highly profitable businesses, this could be a viable option to sock away quite a bit of cash on a pre-tax basis. And as always, our tax and wealth management departments do work closely alongside each other. So there's exceptional added planning value should you choose to go this route. And with all that said, again, pros, cons, pros, it can have tremendously greater contribution limits, but the cons are that it's pretty complex from a administrative standpoint, so the costs will be higher to maintain the plan. As far as the plan limits, just to see them side by side, there is a lot of noise here, but it's intended to just be a reference for when these slides are available to you. The top two lines I do want to highlight. So as I said before, the annual benefit limit for a defined benefit plan, or just call it a cash balance plan, just for example, $265,000 in 2023, whereas an elective deferral, so 401k, your max is 22.5. So it's over 10 times the benefit. So if you are a closely held business with high margins, high profitability, defined benefit plans could be very, very helpful for you in the higher earning years. So finally, we mentioned this a couple times, but we know it's Halloween, so we saved the spookiest for last year. Congress passed this bipartisan Corporate Transparency Act. It's also called the CTA, in an effort to make it harder for individuals to conceal or benefit from dishonest tax practices. It's good news when you're considering efforts to combat any white-collar crime, but it does tack on a lot of administrative burden to all affected taxpayers, even those acting in good faith. The crux of it involves the Financial Crimes Enforcement Network, which some of you may be familiar with that, at least the acronym FinCEN, if you're filing anything for foreign accounts. But their goal is to collect beneficial ownership information. In other words, gathering vital information on who ultimately owns or controls a company. The FinCEN website does note that January 1st, 2024, so a couple months down the road from here, as the date that this will go into effect. But there's still no reporting mechanism available for taxpayers, even as of today. We're mostly just noting this as a heads up because there's going to be a lot of details that are being worked out, but this is also something that you want to keep on the front of your mind because it is so important. I do hope that this section of the webinar provided a little bit of insight on various opportunities for entrepreneurial taxpayers with the goal of starting a business, or those of you who have established closely held businesses and are trying to maximize benefits and minimize costs. I'm sure we all are. So with that, I will get you your final poll question today. Business owners, when thinking about the future, have you taken the step to sponsor a retirement plan? And Rich, I'll get that back to you to close us out.
Great, thanks, Tyler. Just to pick up on a couple of items, the discussions about 174 for R&D expenses, the pass-through entity taxes, and the Corporate Transparency Act will be discussed a little bit more on Thursday's webinar affecting businesses. I'll mention here for the pass-through entity tax that there are various types of deadlines, so it's not one size fits all. Just wanted to make everybody aware of that. I would like to thank Dan, John, Josh, and Tyler for their input today, and to remind everybody that there is much to consider in year-end planning. For those of you who are considering selling a business or maybe have options in a company that is looking to be sold or going public, there are a lot of things in the M&A space that involve the types of planning strategies we discussed today. As a reminder, we're hosting 3 additional webinars this Thursday, the 2nd, for business tax planning, as well as planning and growth and exit strategies for the cannabis industries on November 7th and 21st. Thank you again for spending your time with us today, learning what you need to know. We welcome the opportunity to help you map out a strategy that works for all of you. And as always, we look forward for your feedback. Please reach out to your AAFCPAs tax partner or any of today's speakers with questions.